Something just cracked in the silver market, and you need to see what actually happened. We're talking about a 15% implosion in hours, right after one of the most aggressive rallies in years. And here's the part most people are going to miss. This move had nothing to do with what the mainstream narrative is going to feed you. The real trigger is something different entirely. And if you give me the next few minutes, I'm going to show you the exact mechanical sequence that caused this, why it happened so fast, and what separates people who understand this from people who just got liquidated. Before I explain what caused this move, let me teach you something most people never really internalize about markets. Prices don't move because of opinions. They move because of positioning. Think of markets like a crowded theater. Everything feels calm while everyone's seated, right? But the moment someone yells fire, it's not fear that causes the chaos. It's the fact that everyone's trying to leave through the same door at the same time. That's what silver became over the last few weeks. A crowded trade, leveraged, confident, almost complacent. And when the conditions changed, there was no room to exit gracefully. When professional traders look at price action, they're not asking whether an asset is good or bad. They're asking how many people are positioned the same way and what happens if they all need to move at once. So what does that tell us? It tells us that the sharpest moves happen when leverage meets surprise. And that's exactly what we just witnessed. If this is making sense so far, drop a comment and let me know where you're watching from. Now here's what's actually happening under the surface. The primary trigger was a violent surge in the US dollar, and that surge didn't come out of nowhere. It came from renewed uncertainty around Federal Reserve leadership and policy direction. When traders suddenly don't know who's steering the ship, they don't debate philosophy. They grab liquidity. They grab the dollar. So when the dollar ripped higher, precious metals immediately came under pressure. That part is mechanical. A stronger dollar raises the effective price of silver globally. It makes silver more expensive for buyers using other currencies. Demand softens, supply sits. But that's only the first domino. Let me break down the sequence, because this is where you get the edge. Silver had just gone parabolic. I'm talking about a move that took it from the mid-90s to nearly 135 in less than 3 weeks. Parabolic moves attract momentum funds, short-term traders, and leverage. Lots of leverage. These aren't long-term believers. These are traders chasing price, and they're using borrowed money to amplify gains. So when the dollar spiked, silver didn't just drift lower. Stops got hit. Margin calls kicked in. Forced selling began. That selling pushed price lower, which triggered more stops, which forced more liquidation. It's a cascade. And here's what's wild about this. None of it requires anyone to change their long-term view on silver. It's purely mechanical. You could still believe silver's going to 200. Doesn't matter. If you're leveraged and price moves against you fast enough, you're getting sold out whether you like it or not. Now let me add the second layer, because this gets even more interesting. While the dollar was surging, you also had a sharp decompression in global trade tensions. Word started circulating that tariff negotiations might be progressing faster than expected. Now, you might think that's bullish for risk assets, and in some cases, it is. But here's the thing. Silver had been running partly on safe haven demand and partly on industrial demand fears. The safe haven bid was tied to uncertainty. The industrial bid was tied to supply concerns. When trade tensions ease, even temporarily, you get a relief valve on the safe haven component. That doesn't kill the story, but it removes one layer of urgency. And in a leveraged, crowded trade, you don't need the story to die. You just need it to pause. So now you've got two forces converging, a stronger dollar mechanically pressuring silver, and a shift in trade rhetoric removing some of the panic premium. Neither one alone might cause a 15% flush. But together, in a parabolic setup, with leverage stacked on leverage, that's your recipe. And here's the part that should make you nervous if you don't understand structure. These air pocket drops always feel like something broke forever in real time, even when they're just pressure releases. I've seen this movie before, and I'm going to show you the pattern. Zoom out for a second because this isn't new. This is the exact same playbook silver ran in 2011 after that vertical surge. Back then, silver went from around $18 to nearly $50 in a matter of months. Then it crashed, hard, fell more than 30% in a week. Everyone said the silver story was over. Manipulation, rigged, dead. But what actually happened? Forced liquidation, margin hikes, leverage unwinding. The move was mechanical. And over the following months, silver consolidated, built a base, and made another run before eventually correcting again in a larger cycle. Same pattern we saw in 2020 when silver exploded higher off the COVID lows, corrected violently, and then went on to build a much larger base before the next leg. Every time you get a parabolic move followed by a sudden currency shock or policy shift, you get this kind of reset. The move up gets too fast. Leverage piles in, then something changes the short-term narrative. Not the long-term thesis, just the immediate momentum. And the exit door gets very small very quickly. When you look at the pattern, these moments tend to mark inflection points, not endings. They shake out the weak hands. They reset positioning. They create the conditions for the next sustained move. Because here's what didn't change overnight. Supply conditions didn't magically improve. There's no massive new silver discovery. Industrial demand drivers didn't disappear. Solar panel demand is still growing. EV demand is still growing. Electronics demand is still there. What changed was positioning. And positioning always changes faster than fundamentals. Always. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this move go lower from here? Absolutely. Could there be more forced selling if the dollar keeps ripping? Yes. Could we see silver test support levels in the low 90s or even lower? It's possible. And let me be honest about the manipulation talk you'll hear everywhere. Look, I get it. Markets don't always feel fair. But here's the thing, markets don't need villains to fall. They only need leverage and surprise. Focusing on secret hands and conspiracies doesn't help you. Focusing on structure does. The mechanics I just walked you through explain this move completely without needing a single bad actor. It doesn't actually matter whether someone wanted this to happen or not. The structure was there. The trigger appeared. The result was mechanical. The only thing you can control is how you react, not how the market behaves. There are probably 3 types of people watching this right now. Maybe you're the long-term silver believer. You've been stacking for years. You've been waiting for pullbacks. And this feels scary, but also interesting. If that's you, your job is patience. Let the dust settle. Let volatility contract. Don't rush in trying to catch the exact bottom. You don't need to. If the thesis is intact, you'll have time. Watch for stabilization. Watch for volume to dry up on the sell side. Watch for the dollar to lose momentum. Then you can make your move with more information and less emotion. Maybe you're the short-term trader who got caught in the flush. Maybe you had a position that looked great 2 days ago, and now you're down double digits. That hurts, and I get it. Your job now is to step back and reassess risk, not revenge trade. The worst thing you can do after a loss is immediately try to make it back in the same instrument that just burned you. Take a breath. Review what happened. Ask yourself if your position size was appropriate for this kind of volatility. Ask yourself if you had a plan for a scenario like this. And be honest about whether you're trading or investing. Because if you're trading, you need stops. You need risk management. You need to accept that moves like this are part of the game. And maybe you're newer to this space. Maybe you're just trying to understand why something labeled a safe haven can feel anything but safe. If that's you, this is the lesson. Safe doesn't mean smooth. It means structurally supported over time, not immune to air pockets. Gold and silver can be safe havens in a macro sense, while still being volatile in a short-term sense. That's not a contradiction. That's just how markets work. And if you're going to participate in these markets, you need to understand the difference between long-term conviction and short-term positioning. So here's what I want you to answer in the comments. Which type are you? Long-term holder, short-term trader, or newer observer? And what's your biggest question about what just happened? I want to know what you're thinking. Here's where I stand. I'm not panicking, and I'm not blindly buying either. I'm watching 3 things very closely. First, I'm watching the dollar. If it keeps accelerating, if it breaks through key resistance and keeps running, pressure stays on silver. The mechanical relationship is too strong to ignore. A dollar that's ripping higher creates headwinds for all commodities, especially precious metals. So I need to see the dollar start to roll over or at least stabilize before I'd expect silver to find a sustainable bottom. Second, I'm watching whether silver stabilizes without heavy volume selling, because that tells you forced liquidation is ending. When you see price flatten out and volume drop, that means the sellers who had to sell are done. What's left are the holders and the buyers. That's when you start to get a foundation. And third, I'm watching how fast sentiment flips from euphoria to despair. That swing matters. When everyone goes from talking about silver going to 200 to talking about silver going to 70 in the span of 3 days, that's a sentiment extreme. And sentiment extremes tend to mark better entry points than consensus moments. Based on my analysis, this move was mechanical, not emotional. It was structural, not fundamental. The underlying narrative around silver, the supply constraints, the industrial demand, the monetary concerns that were driving interest, none of that got invalidated by a currency spike and a tariff headline. What got invalidated was the parabolic price structure that couldn't sustain itself under leverage. And if history rhymes, if silver can stabilize here and build any kind of base, the move that follows could be significant. Not because I'm predicting it, but because that's what the pattern shows when you remove weak positioning and reset the structure. The fundamentals don't need to improve for price to move higher from a reset base. They just need to stop deteriorating. And right now, they haven't deteriorated at all. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the dollar chart, check the volume, check the historical precedents. Don't take my word for it. If you made it this far, you're the kind of person who thinks critically and doesn't just react to headlines. That mentality will serve you well, not just in silver, but in every market you touch. If this breakdown helped you see what's really happening under the surface, do me a favor. Share this video with someone who's confused or panicking right now. And if you're not subscribed, hit that button. Because this kind of analysis, this is what we do here. We don't hype. We don't panic. We analyze structure and we stay ahead of the noise. Stay sharp out there. Think critically. Verify what you hear. And make decisions that fit your risk, not someone else's conviction.